Good morning, traders. Welcome back to today's daily market analysis. I'm Adam Alhuz from BCR, bringing you the latest insight and key levels for the markets. Let's dive straight in and look at the dollar index, crude oil, and AED USD. If we take a look at the charts, we can see that the US dollar declined against all major currency pairs this week. The December JOLTS report showed fewer job openings, signaling a cooling labor market. This pushed the dollar index below 108. Market also reacted to the new US tariffs on Canada, Mexico, and China through President Trump's decision to delay tariffs on Canada and Mexico by a month. This eased tensions temporarily. The index briefly hit 110 before the tariff delay announcement, but quickly retreated to 108. Strong consumer spendings of 4.2% highlighted economic resilience, but Fed officials gave mixed signals. Chicago Fed's Goolsbee hinted at lower rates ahead, while Governor Bauman urged caution. Technically speaking, the US dollar index remained weak. The momentum indicators like RSI and MACD showed no recovery, suggesting bearish pressure could persist. If selling continues, the index might test 107.8, which is January 31 low, with a break below opening the doors to 107. Resistance sits at 108.5 and 109. If we take a look at crude oil, we can see that prices fell for a second day, trading near $70.40, close to last week's 1 month low, before rebounding above $72 and slightly above the 100-day simple moving average support. US President Trump announced a 1 month delay in new tariffs on goods imported from Canada and Mexico. This eased concern about potential supply disruptions from the two major oil suppliers to the United States and put pressure on crude oil prices. At the same time, the Organization of Petroleum Exporting Countries and its allies, OPEC, rejected Trump's call to increase production to reduce prices and maintain the current oil production plan. From a technical perspective, crude oil prices rose to $74.52, a high at the beginning of the week, and then continued to fall low to $70.40. The market risk appetite fell, forming a decline, and the 14-day relative strength index, the RSI, of technical indicators is still fluctuating in a negative zone. The latest report is still around 44. It has now fallen below $73, a round number support, psychological support. Observe whether this is effective or if it continues to break below. The oil price is likely to return to the bearish range. The initial support is $71.11, which is the 100-day moving average. And if it breaks, it will test $70, which is a very strong psychological support. As for the current resistances, you can first consider $73.10, which is a 9-day moving average, and then $74.52, the high point at the beginning of the week. Finally, we will take a look at AUD/USD. The Australian dollar rebounded sharply, breaking a 6-day losing streak. AUD/USD climbed to 0.6265 as the US dollar weakened after Trump delayed tariffs on Canada and Mexico. However, volatility remains high as investors watch China trade talks, which is critical for Australia's economy. Now, we also take a look at the RBA as they might cut rates in February, but they insist that inflation must stabilize within the 2 to 3% target first. Technically, the pair dipped below 61 cents early in the week before a V-shaped reversal and recovery above 62 cents. While still in a bearish channel, the RSI rising above 50 hints at weakening downward momentum. Key support levels may test 0.6164, which is January 17 low, and the lower lines of the descending channel at 0.6150. A break below the channel will lead the pair to the area around 0.6131, which is January 13 low. Upside resistance can be seen at 0.6287, which is the 50-day moving average, and 63 cents, which is the market psychological level for most traders. I would like to thank you all for listening to today's market analysis. As always, remember to plan your trades and trade your plan. Good luck and happy trading.